if you have started earning, the next question is where to invest, how to invest, what are the choices that I have, because I'm very sure either there will be problem of plenty or you will not be understanding what is the risk and reward which is associated with each asset class. So in this case, this video is for you. In this video, I am going to discuss 4 asset classes which you can consider while developing your own portfolio. Asset class is real estate. This is everyone's favorite asset class, I know. Most of Indian saving or investment is linked to this asset class. Why? Maybe because of these 3 reasons. First one, see the sense of assurance. It is a tangible asset class, means when you are buying a flat or a commercial complex or any kind of residential property, you can touch, you can feel, you are living in that property. This kind of assurance you cannot get when you are holding shares or anything in dematerialized form, right? Second one, it is dream for everyone to own their own house or some complex in a posh locality because often this is considered as status symbol. Third, we are made to believe that this is the stable, safest asset class. Even when there is a turmoil in financial market, this housing market or the real estate will not be impacted. This is what we are made to believe. But look at the reality. Take the rental yield itself. If you compare the rental yield in NCR, National Capital Regions such as Delhi or Bangalore, see, it is just 2 to 3%, which is the lowest in the world. Why? If you think we need huge investment if we want to buy any property in India, so the capital which should be infused is huge. And the rental yield, it doesn't actually match with the increase in the property price. That's why your yield is actually the lowest here. Second important point to consider is huge opportunity cost. What is that? Opportunity cost simply means if you have A and B option, you choose A. That means you have forgone something in B. By choosing one option, you are not able to get the benefit what probably B would have had. So the same logic if you extend here, see, I have salary of 50,000, let's assume, and I want to buy a flat. So I go to bank, I take loan and I start paying my EMI. So if my EMI is 15 to 20,000, which continues for another 10 to 12 years, let's assume, in that case, my ability is restricted to that extent. I can't invest in any other asset class because majority of the saving is going just in finishing of the loan. That too for 10 to 12 long years. If you consider the money value, you have actually dreamt of owning a property and you have converted this EMI. You have bought that in liability. It is not asset. The EMI is essentially liability and you are actually foregoing another option which is existing somewhere else where probably you would have generated great rate of return. This is the concept of opportunity cost, which happens in India because most of the time people go for purchasing real estate without even having 10 to 20 lakhs of extra savings in their bank account. If you are a person who is looking for taking exposure in real estate because you believe in this theme, it's all right. You should have certain exposure for real estate in your portfolio. What is the best way? If you don't have that kind of huge lump sum capital which is required in case of buying a physical property, this is called REITs. These are Real Estate Investment Trust. These are the trust which accept money from investors and they invest this amount in any income generating asset. Maybe it is a commercial complex or office space or any residential property, etc., where the income is generated. It actually functions like mutual fund. This is completely regulated and monitored by SEBI, the capital market regulator, and SEBI rules require that 90% of the income which is generated by this trust should be distributed among the investor. That means you can expect some stable return. And there is also a rule which requires this trust to invest at least 75% of the amount in income generating asset class. So that means you are blocking that under construction risk which you fear the most always. If you think REITs, you can buy it with 400, 500 rupees also. So you do not need lump sum amount. How do you buy? Just like how you buy shares. You should have a demat account and then you will be able to buy REITs and trade and receive the dividend income. Second point is gold. We know we Indians love gold. But if you think what return gold has given in last 1 decade, it is 3 to 4% maximum. That's it. I completely agree. Gold can be used for hedging purpose. Hedging means you pick two assets which take two different direction. For example, gold usually behaves in opposite way when you compare it to the stock market movement. That means if the stock market is going up, gold will go down. And when there is a volatility in the stock market, gold goes up. So this is a principle of hedging where you try to reduce the volatility in your portfolio by investing in two asset class which move in opposite direction. If this is the sole purpose, then you should be thinking which form of investment is suitable for you here in this gold. Is it physical? Think. You go to the shop and then you pay GST and 10 to 20% making charge in case of ornaments, and then you cannot risk keeping all this gold at your home because there is risk of robbery, theft. So you straightly go to the bank and then you pay locker charge. Again, there is cost involved in maintenance. So is there any alternative to this headache? Yes, there are. The first option is ETF. ETFs are traded in open market in any stock exchange just like our share, and they track the movement of real gold. But there is also one problem. That is nearly 1% of charge is involved when you are buying gold through ETF. Because see, the stock exchange executes your selling and buying orders. So definitely there will be some cost associated with that. Now what if you want to have an option where there is some income generated and no cost? Then we will come to the third option, which is SGB, that is sovereign gold bond. These are basically issued by Government of India. So RBI usually issues these bonds. This is not available to NRIs, only to the resident individuals. And you can stay invested for 8 long years. You have an option of exiting from the investment starting from your 5th year. 5th, 6th, 7th year. If you don't want, you can exit, but there will be tax implications. And if you want to reduce the tax, again you will have to wait for a window which is opened by RBI, which is actually called as buyback window. Means RBI comes up and says, look, this is the time frame. If you want to return these bonds to us and exit the investment, this is an opportunity. And here in this buyback window, you will end up getting indexation benefit for the long-term capital gain. If you stay invested for all 8 years, it is completely tax exempt. And another interesting part is you get 2.5% of interest, which is paid semi-annually or every 6 months. Now tell me, what can be the best option which is secured because it is issued by Government of India and at least some kind of interest or return is generated, maybe 2.5%, which may not be enough when you compare with inflation, but rather than holding in any other form where there is only cost and no return, this is far better. And the third point is, if you can hold it for all 8 years, then there is going to be a tax exemption. Third point is bonds. Let's assume you are a risk-averse investor. You do not like shares, but you are very comfortable in giving loan to somebody who will not default. Probably the risk of default is less and you want to receive that interest income. So then what is the choice? Bonds. When you are giving loan to any corporate or the company or the government, you become bond holder. Obviously, the next point is your return should be in the form of interest, right? So this is called as coupon in bond. Coupon does not change according to the market value of the bond. What rate is stated when you are buying the bond? Say 5% means it is 5% during the holding period. But there is one more important terminology. That is called as bonds yield. That means here the return divided by the market value of the bond. Let me give an example to that. Let's assume I am buying a bond which is worth of 100 rupees and my return is 5 rupees. 5 divided by 100, that means now my yield is 5%. Tomorrow, let's assume the bond's price, it has fallen down to 50 rupees. So now it is 5 divided by 50. So the bond yield is 10%, not 5%. So this yield always fluctuates according to the market value of the bond, not the coupon which you are going to receive. Now, if you are a risk-averse investor and believe only in buying the bonds from the government, that's also perfectly fine. In India, you can do it either through the brokerage, otherwise go to RBI Retail Direct and then furnish all the documents which is required. Then you will be able to place an order. It may be for short-term or long-term bond. It starts with 91 days, 182 days or 1 year, even 20 year, even 40 year, according to the time frame that you want to hold. So now, when I am talking about the bond, the important concepts are only the yield as well as coupon rate, which comes as written here. Fourth is equity. This is nothing but share in any company. What is share? See, if I have 1 lakhs rupees of share in Infosys or TCS, that means I am owner in these companies to the extent of value of this 1 lakhs. So this gives me ownership right. Now it's quite obvious, when you are an owner, definitely your risk as well as return both are high. That means when you compare it directly with the debenture or bond holder, your risk is very high. If the company faces liquidation and it goes bankrupt, that means you will lose your capital. At the same time, if it performs well and generates higher rate of return, your profit share also goes up. Now let's talk about the second point. How can you make money by investing in equity? First one, dividend. Second one is capital appreciation. Talking about the dividend, this is nothing but share in the distributable profit of the company. So company makes revenue. You are deducting all direct, indirect costs, interest and everything related to that. Then what is remaining to be distributed for equity shareholders? If board of directors decide that let us distribute this in the form of dividend, you get your share. So this is called dividend. There are many companies which give really good dividend in India. Second is capital appreciation. Just like any other asset class, maybe your property or bonds, when the performance of the company goes up, its share value also goes up. For example, if I have bought the share of ABC Limited at 50 rupees, if it performs too well in 5 years, maybe I will be able to exit the investment at 500 rupees. So my investment has gone up from 50 to 500 rupees. Then my profit depends on how many shares I hold in that ABC Limited. This is how the capital appreciation works. But remember, if you are thinking of making direct investment in share, it is must for you to have idea about the fundamental analysis where you will be able to judge how the sector performs, even the industry or the competitor including that company performs. Otherwise, there is high chance that you might end up placing a bet on the wrong company and burning your cash. In this case, then what is your option? Now, if you do not want to risk investing directly through the shares, the next available option is indirect investment. That is where index investment and mutual fund comes into picture. Index is nothing but basket of the shares. For example, if I talk about the Bank Nifty, then you have all the stocks which are there in the Bank Nifty and you buy a proportion of that basket. Or if you want to invest in Nifty 50, that means all the companies which are there in Nifty 50, you will be able to buy at a price. This is passive mode of investment where you do not have to supervise, because usually what happens, if out of 10 stocks, if 3 don't perform well, even 5 don't perform well, if other 5 are performing really good, that means you will be able to get very good return. And usually in case of index, since it is completely passive, there is no active management, the cost involved is always less. The other option is mutual fund. Especially for the goal-based investment, mutual fund works. There is a manager or who is a professional managing portfolio on your behalf. So obviously now there will be a fee which will be charged by him for taking care of your money, right? That's why the expense ratio in the mutual fund is slightly higher than what you will see in index fund. So depending on what you are comfortable at, you can choose either index or the mutual fund route to take exposure in equity. Now I believe You got fair understanding of what are the options broadly and what will be the risk which is existing in each category and how can you diversify your portfolio. If you have any doubts, please post it in the comment section. I'll answer it there. And thank you for watching.